Ladies and gentlemen, welcome to another Independent View with your host, Lobo Tigre. Our guest of the day, I almost said victim of the day because usually I'm grilling some mining company CEO, but our guest of the day for this Independent View is Brent Johnson of the dollar milkshake theory. Now, some gold bugs might wish I would grill Brent, but don't shoot the messenger. He happened to have a strong dollar thesis. It happens to be playing out in spades at the moment as we speak, and therefore it seemed prudent to talk to him. But before we go there, Brent, I think most people know what is meant now by the dollar milkshake theory. I think it's amazing that a somewhat known dynamic of relative central bank policies has your name on it now, and your moniker, the dollar milkshake, has become how this is referred to. But can you just quickly walk us through how this works? I mean, dollar milkshake is, as I understand it, neither inherently bullish nor bearish dollar. It's about the relative actions of the central banks, and at least at the time you said this, why that was bullish at the dollar, because the others were pushing down while the Fed was pulling up. So is that right? And can you summarize it quickly for us?
So I think the best thing to do, the way to start this off, because this may be very appropriate to some of your listeners, is that to let people know that what I do is manage money for individuals. So I'm not managing money for pension funds or endowments, or where there's a bunch of experts or professional finance people on the other side of the table for me. I'm explaining to individuals who they're very successful, they're very smart, they've got a great portfolio that they've built up through hard work or entrepreneurship or whatever it is, but they're just not finance people, and so they don't necessarily know the lingo or the right way to approach investing their portfolio. So that's where I come in. And so when I'm explaining to them what I think is going to happen, I can't use terms like credit default swap or monetary policy or derivative, because they don't necessarily know what those are or how they work. So I have to kind of put it in layman's term for them. And so the milkshake was basically a simple way for me to explain what I thought was going to happen and how I thought a sovereign debt crisis would play out. So when I first came up with the term dollar milkshake was back in 2018. So it's 4 years ago. And so, a lot of people have said to me, well, Brent, it hasn't happened yet, or maybe it's happening now, but and in my business, when you're early, you're wrong, right? So I'm happy to say I got the timing wrong. I don't know if I'm even going to be right in the long term. I think I will be, but I don't know for sure. But what I was explaining back in 2018 was that over the previous 10 years since the global financial crisis, the global monetary authorities, the governments, the institutions as it is, provided a ton of stimulus, liquidity, bailouts, fiscal spending, however you want to describe, extraordinary monetary easing, however you want to describe that. They provided the world a milkshake of liquidity. They flooded the world with liquidity in order to save the system. And that I thought, for a number of reasons, as we go forward in time, the U.S. would be the one that had the straw. And so the U.S. would drink the milkshake that the whole world was mixing. Now, I think the first time I started talking about it was in 2018 or 19. And at the time, the U.S. Fed was in the process of raising interest rates. They had started at the end of 2015, and then I think they did another one in 2016. But then in 2017 and 18, they were on a hiking schedule.
And QT, the famous paint drying.
That's right. And so at the time, that was the prominent reason that I thought the dollar would strengthen. Now, that wasn't the only reason. I think there's a number of other factors that give the U.S. dollar the quote-unquote straw that drinks the milkshake, but interest rates are a huge part of it. And so, as the Fed was raising interest rates, the dollar was getting stronger. Now, then they pivoted. At the end of 2018, they pivoted, and the dollar fell off a little bit. But then, as we got into 2020, then the crisis started from COVID. Started to ramp up, and the dollar got very bid, right? And we all know what it did in March of 2020. It spiked. And then the Fed came in again, and they got very aggressive with monetary policy, and so the dollar fell. But then over the last year, the Fed has been tightening again, and now the dollar's gotten stronger again. And the thing that I would say is that the reason that I think the dollar will get stronger, and I think it will continue to get stronger.
Actually, let's come back to that, Brent. Sorry, let me jump in. Let's come back to looking forward, and before we move on from what happened in the past. For your critics, as you've just laid it out, and I'm thinking about what was happening at those times. In my view, okay, you say there's more to it than just interest rates, relative policy of the central banks, but that clearly is core. And it seems to me that this actually bears out your thesis. Okay, you were wrong about Powell pivoting in late 2018, but had that not happened, what was happening was consistent with your thesis. The Fed was tighter than the other central banks, and the dollar was rising. And then Powell pivots. Okay, so that doesn't disprove the dollar milkshake. It means, okay, you call that wrong, but Powell pivots. The Fed's no longer tighter than everybody else. The dollar softens. That actually jives with your theory. And then what you're saying about 2020 and the massive liquidity that the U.S. injects, like before everybody else, just jumps in with both feet. That's weak dollar. That's consistent. The Fed's no longer sucking on the straw in the milkshake.
Right.
So the dollar goes down. And then now, here we are. The Fed has led everybody else. I mean, just as you and I speak, we'll get this process as quickly as we can. But as you and I speak, Lagarde, who some like to call Lagarde, has just announced the 50 basis point hike, the shock, and the dollar's down, the euro's up, and it's relative tightening again. So it's consistent with your theory.
Yeah. Now there's a reason I should point out, because interest rate are not the sole straw, but it's one of the leading ones. But it's some of the other parts of the straw that I think have led to the dollar getting stronger now, as opposed to just interest rates.
Okay.
And part of the big driver of the dollar strength is the demand for the dollar. And a big driver of the demand for the dollar is not just the dollars inside the United States, but there's a whole dollar market outside the United States called the euro dollar market. And I think a lot of people know that in the United States, we have like $30 trillion of debt that the government has borrowed, right? We're that far in debt. So, but what many people don't know is that there's entities outside the United States that have borrowed 13 to 15 trillion of US dollars in US dollars. And they haven't borrowed those dollars from the United States. They've borrowed those from other entities outside the United States. That's when Turkey borrows money from a bank in France, or Australia borrows dollars from a bank in Japan, or whatever it is. That's a euro dollar, and there's an incredible amount of demand for dollars outside the United States. Now, the reason that I think the dollar got stronger, came down, got stronger, came down, and now is strong again is because in those time periods where the dollar falls, when the U.S. starts to move to easy monetary policy, and the dollar falls, that would be an opportunity for the rest of the world to either pay off or get out from underneath or stop borrowing in dollars. Unfortunately, they don't do that. Whenever the dollar falls, they actually take out more dollar debt. So we end up right back where we started 2 or 3 months or 2 or 3 years.
Well, hey, Donald Trump said we should do it too. Dollar's down, we should borrow more.
Right. And so if the rest of the world decided to leave dollars, that would be a problem for the United States. But the issue is that the rest of the world has not chosen to leave dollars. Now, they will do trade deals bilateral trade deals amongst nations. They will set up trade agreements to where they can bypass the dollar. But as a whole, there is more dollar debt outside the United States today than there has been in any other time in history. And so in order for the system to change, I think the rest of the world needs to stop going back to U.S. dollar debt. And the reason they issue U.S. dollar debt, or they borrow in dollars, is because if you borrow in dollars, you get a lower interest rate. If you're a shoe manufacturer in Sri Lanka, as an example, and you want to borrow in dollars, your interest rate is going to be much lower than if you borrow in local currencies, or if you issue bonds, or whatever it is. And so, and because they sell their shoes to the United States and they get revenues in dollars, they're kind of matching their liabilities with their revenues. So they take the currency component out of it. And so it's not just as simple as the rest of the world just deciding they don't want to use dollars anymore. There's a lot that goes into it. Interest rates are a big part of it. Dollar debt's a big part of it. Global trade's a big part of it. And, the part that most people don't like me talking about is the military is a part of it. The U.S. enforces all of this as well. And so I think for a number of reasons, that's kind of why we're seeing the dollar strong right now.
Okay. That's really interesting, and I had not processed that fully. So let me think about that. It strikes me, though, that, okay, I see that as being sticky. I see it. It's not the sort of thing, even with war and politics, making people out there making speeches and stuff, it's not the sort of thing you just change overnight. It takes time to swing the bow of the Titanic. That said, we're seeing a new Iron Curtain go up with gusto. I mean, it seems like over time, that has to be bearish for dollar for this very reason, that structurally, large chunks of the world will move away, whether they want to or not. They'll be pushed by policy and incentives to move away and to using the dollar less and less over time. Does that make sense to you?
I agree with it. No, I absolutely agree with that. And, most people who listen to the entire theory understand that is part of the theory, actually. Like, my theory says that it's the dollar's strength which will necessitate a new system as opposed to dollar weakness. Because if you think about it, remember how I've said over the last, call it 10 years, every time the dollar's gotten weaker, the rest of the world has gone out and borrowed more. I apologize. There's an ambulance going right past my apartment right now.
It's okay.
But, over the last several years, whenever the dollar's gotten weaker, they've gone out and borrowed more dollars, which doesn't move the system away from dollars. It actually entrenches dollars in the system. And so if the dollar continues to weaken, I think that would continue. Just people would continue to borrow in dollars. But as the dollar gets stronger, that wrecks the whole system. That kind of brings the system to its knees. It necessitates a restructuring. And so I believe that what will happen is that the strong dollar will just necessitate a new system or a restructuring. And so, and then the dollar will not only fall, but it will fall and stay down. And I think that's what will happen. It's just that I don't think we're there yet. I think typically big changes like that, especially like a global reserve currency, that's a huge thing, right?
Yeah, that's a century level regime change issue.
You hear about these once every 100-year storms all the time, but this actually is a once every 100-year storm. And, I think it's the biggest network in the world. The dollar network, the number of people that use dollars and transact in dollars, it has the network effect. But something will have to be done, I think, as it gets strong to reset that network to something else. I just don't think we're there yet.
This is actually quite consistent. This is quite consistent with I have to say a somewhat long-standing prediction of my friend Doug Casey. Has not framed it the way you have, but he's talked about this currency regime change, and then when all those dollars come home to roost, the impact that has. I mean, it's maybe not the end of the world, but it would be a highly destructive event with, presumably consequences for the United States on the order of, when Great Britain passed on the baton. But my other friend, Adrian Day, he likes to point out that, okay, when Great Britain became somewhat less great on the global stage, the U.S. was there, spoke the same language. Maybe the Brits weren't entirely happy to not be the top dog anymore, but it was a somewhat friendly-ish transition. There's nothing like that now. The U.S. certainly doesn't want to pass the baton to China, not willingly. Maybe we don't need to get into politics or whatever. I'm not asking you to predict World War III, but let me keep it on the money then. What's the substitute? If the dollar falls, what takes its place? I mean, the euro, they look like they're about to disintegrate. The yuan, nobody trusts the transparency there. The ruble, forget it. Is it Bitcoin? Is it gold? Is it something else? What happens? What becomes the global reserve currency if the dollar no longer serves that role?
Well, so I think there's a couple steps to this. The first thing I'll say is the transition from Great Britain to the United States as a global hegemon is kind of unique. It typically doesn't happen like that. And I think it happened like that because we were allies and they really needed the help of the United States in World War II, right? Typically what happens
is
a great power is defeated resoundly in a war, and then the new power takes over and implements their will on the rest of the world, and they use whatever currency they want to use. I think this is pure speculation on my part, but because a big part of my thesis is that there's just no good alternative right now from an economic standpoint, and I don't think that there's anybody that can knock the U.S. off the mountain militarily. Now, that doesn't mean that the U.S. can win every war and they're undefeatable. But my point is the U.S. doesn't have to win a war. They just can't. As long as they don't get knocked off the top, they're still the top dog, right? And so what I think is more likely to happen is I think we will have some kind of just a global crisis, literally a global currency crisis or sovereign debt crisis, in which case the world will have to come together and come up with some new system. And maybe that system is a basket of currencies. Maybe it has gold in it. Maybe it has some oil in it. Maybe it's a combination of currencies and commodities. And then I think the next step would be, okay, now somebody is actually strong enough and, can impose their will on everybody else. Maybe they knock the U.S. off. But, this could be 10, 20 years down the road. I don't think this is something that happens in November. Now, it could happen. That's the thing. It could happen in November. I don't think it's going to, but it could. So you kind of have to be ready for that. But
actually, let's do that. Let's transition then. Okay, there's the theory. Here's the big picture. Here's how things could go. As a money manager now, and by the way, maybe could you say the name of your company? Because if I say at the end of the interview, Brent, why don't you tell us where we can find more? Then by then everybody tunes out. So here you go.
No
What's the name of your company? And then let's talk about now. What do we tell clients now?
So the name of my company is Santiago Capital. It's a wealth management firm. I'm based in Puerto Rico, just down the street from you. Most of my clients are domestic U.S. I've got a few in Europe and a few in Asia as well. And you can find me if you go to santiagocapital.com. There's some contact information there. I don't have a lot on the website for regulatory reasons. But if you go to Google or YouTube and type in Santiago Capital or milkshake theory or something along those lines, you'll get a number of links similar to what we're doing right now that you can watch. And I'm always happy to
I'll put a link in there too.
Reach out. Yeah. So that's probably the best way to get in touch with me or follow what I'm doing.
Okay. So what do we tell clients now? What are the implications as you see the world today? The central bank policy and the macro picture and the geopolitical picture. What does the dollar milkshake theory tell you to advise clients for the near-term investable future?
Yeah. So what I tell clients, and they don't all listen, I should say that.
Well, I actually like that. I mean, I tell clients of the independent speculator that that's not just me. The goal is for them to think independently. I think of myself as a due diligence guy. I'm like a gun for hire through the newsletter. But I want people to think independently. I want them to call their own shots. Hopefully I can help in that. But anyway, so yes.
So my recommendation has been and continues to be to favor. Well, first of all, I think the two most important people can own in their portfolio right now is dollars and gold. Have some gold and have some cash. Now, everything else can be nuanced and we can kind of work around that, but everybody should have some gold in their portfolio and everybody could have some cash. I think if you have those two things, you will at least get through whatever there is to come. You may not prosper, you may not make as much money as your neighbor, but you may make a lot more money than your neighbor, and you will at least survive. So it's kind of my whole thesis is kind of survive in advance. Just live to fight another day. That's the first thing. Live to fight another day, and I think gold and dollars will help you do that.
Let me jump in and concur with that. I have a friend, an old school chum in Switzerland. He likes to say he's an old money manager in Switzerland, and his saying is that gold may not make you rich, but it will prevent you from becoming poor.
There you go. That's a perfect way to say it. Now, once you get past that, I think that investors should favor, and it doesn't matter whether you're U.S. based. I think it's true if you are U.S. based, but I think it's even more important if you're not U.S. based, and if you're not a U.S. dollar denominated investor. I think you should favor U.S. assets as opposed to foreign assets, and U.S. investments as opposed to. I think as the dollar gets stronger, you're going to see a number of emerging markets come under pressure. And so I'm staying away from EM. I'm staying away from international. I'm staying away from long-term duration. Now, it will not surprise me if bonds get a rally here, because they've gone down so much. If we get some kind of a risk-off event, I do still think U.S. Treasuries will be seen as a safe haven. So it will not surprise me if long-duration bonds do well, let's say over the next 6 to 12 months. But I'm not allocating capital there. I have some allocation to short-term fixed income, but again, I'm staying away from international, and I'm doing U.S. Treasuries, short to medium-term U.S. Treasuries for fixed income. If you're going to be a real estate investor, I would favor real estate assets in the United States over Brazil or Australia or Canada. I think a number of international markets are going to have real estate bubbles. I think Australia, Canada, and China all have real estate bubbles, which will deflate in the coming years. So that I'm really kind of focused on U.S. assets. Again, we own some equities; they're hedged right now. We own fixed income; we're keeping it short duration. We have in the stocks that we do own, we have a lot of energy exposure. I think energy will do very well in the coming years. From a commodity perspective, I like the agricultural commodities even more than the industrial commodities. But I think everybody should be diversified, and I think everybody should be open to being wrong. One of the biggest things I see going on right now is that people are so certain that they're right, which is amazing to me, because I've been doing this for almost 25 years, and it's the most uncertain time I've ever seen.
Yeah, no, sorry,
you're
let me jump in, Brent, because you're touching on one of my pet peeves, and I love that you said that, because it just drives me crazy how we are truly in uncharted waters. I mean, we went on uncharted waters in 2008, and that was nothing compared to what we've done since 2020. And even the powers that be, even Powell will say that, we don't really know what's going on, that we're in uncharted waters. And yet the next thing they say is, therefore, here's our plan. Like, here's our chart. We're in uncharted waters, and here's our chart. Like, why don't people see that there's something wrong with that? Sorry, so yeah. I'm agreeing with you.
Well, no, this is part. You kind of got to understand, like, if you put all the different pieces of what I've said together, I think it'll help understand why I'm saying what I'm saying. So, first of all, I've said, it's a very uncertain time, right? The next thing I've said is own dollars and gold, because you just want to survive in advance. The most important goal is to just get through it, right? And then the next thing is I've said, favor U.S. assets rather than international assets. Now, I'm not saying you don't own any international assets, and I'm not saying you have to put everything in the U.S., but the point that I'm trying to make is that I do not believe that it's possible that the U.S. goes into a really bad recession and the rest of the world does well. So what I think is possible is the whole world, for whatever reason, could go up together. Maybe they discover some new technology. Maybe there's some demographic boom for whatever reason, and the world grows its way out of this problem. I think that's pretty low probability, but it's possible. The other thing is we could all go down together. We could have a big global crisis like 2008, and everything goes down together. And in that, if everybody goes down together, I'm no worse off being in the United States than being overseas. The other thing is that the U.S. could potentially do okay, and the rest of the world does bad, in which case I'm better off being in the U.S. Or the last thing that could happen is that the U.S. could go down and the rest of the world could go up. But I think that last thing is so low on the probability scale that in all the other that I don't feel I need to allocate to it. And if I do allocate to it, it's a very small percent. But in the other three scenarios, I'm just as well off, if not better well off, being in the U.S. as opposed to the rest of the world. So that's why I'm favoring U.S. investments. Now, the last thing I'm going to say on this is that this is not a jingoistic, the United States is the greatest place in the world. I'm Captain America and you guys are all a bunch of losers. That's not what this is about. This is trying to be as objective as possible, standing back and looking at the different places that I can allocate capital based on the world as it is, rather than the world as I would like it to be, and saying, I think that's where we want to focus our assets.
I understand that. So let me poke at that last one just a little bit for clarity. Sure. If there were circumstances where it would make more sense to focus more on EM than the U.S., you would go there. Like if your economic analysis
Sure.
was that was the right thing to do. Okay. Let me ask about that then, because this comes up a lot. We have a fellow Puerto Rican who's real big on EM because he's a dollar bear. And my question with that is always, okay, if you're a dollar bear, it makes sense to look at other economies maybe, but But EM specifically, as opposed to, say, Europe. I don't see Europe as EM. Well, not Western Europe anyway. But am I going to go bet on, Guyana or Venezuela or something as a contra-dollar play? I mean, EM, emerging markets, they still have, rule of law issues. There's all kinds of other risks there that have nothing to do with whether the dollar goes up or down. So when people say, okay, under these circumstances, I'm bearish dollar, I'm going into EM, that always makes me nervous. Do you have any thoughts on that? Am I crazy?
Yeah,
or?
so no, I think you're absolutely right. And listen, I'm not saying don't have any money in EM, but when I hear people saying, the U.S. government is out of control, they're spending money left and right, get out of the United States and go to the emerging markets. That's when I'm like, hold on, right? If you are going to go to the emerging markets, I'm okay with having a small percent of your portfolio there, or maybe the part of your portfolio that you allocate to a little bit higher risk, higher reward strategies. I just don't think everybody should pull all their investments out of the United States and put them in the emerging markets. Again, try to keep everything within reason. You don't have to go all in on anything. That's the other thing. I feel like a lot of people, they get certain on their thesis and then they go all in on it. You don't need to go all in on it. I can think of very few reasons to ever go all in on anything. I'm not saying it's impossible, but it's just unnecessary. If you have a 20% position in something, that's a huge position. That's an enormous position. So, if you're going to do it, just recognize the risks.
I understand.
And don't go crying if you get blown up.
I'm not the poker player that Doug is, but I understand you can lose with 4 aces. So even if you're highly confident of your thesis, it's not a sure thing. Okay. There's one other thing. There's one other point I'd like to make. Okay.
And the reason I'd like to make it is because I feel like this is coming up more and more. So a year ago, I had a lot of people telling me the dollar index was not going to rise for many reasons. Now it's up, 15 or 20% in the last year. So now the narrative has become, well, yeah, the dollar index went up, but it doesn't buy any more food, it doesn't buy more gas, it doesn't buy any more things that I actually consume. So the fact that the dollar is strong versus other currencies is irrelevant and it doesn't matter. And I think I'd be very, very careful of accepting that as a true statement. And the reason is because the US dollar is the underlying collateral for the entire monetary system. And because of all the debt that's out there in dollars, if the dollar goes up, it puts pressure on anybody who has borrowed in dollars. And if defaults start to happen, it can cause a chain reaction of one default leading to another default. And then you get markets just cratering like we had in 2008 and like we had in March of 2020. And so in that scenario, even if you think that the dollar is a poor form of fiat, it's still going up in terms that people have borrowed in. And it can lead to a situation where money disappears because of the collapse of the money supply. And then all of a sudden you get bankruptcies. And in that situation, all you got to do is go back to 2008 and March of 2020 and look, everything went down. Bonds went down, commodities went down, gold went down, stocks went down, real estate went down. So you don't really have the ability to escape it. And the dollar going up affects everybody. Even if it's just fiat, it does have the potential to dramatically affect everybody. So
Sure.
Again, I'm not saying you have to make your base case that the dollar's going higher, but just be aware of what happens when it does.
Well, and yeah, you're pointing out systemic risk, but which is always something to keep in mind, that possibility. But even beyond that, I don't know the precise number, but something like, 3/4 of S&P 500 companies have a heavy reliance on sales outside the U.S. So you think you're investing in the U.S. if you're focusing on the S&P 500 or some U.S. stocks, but you're not. No man is an island, right? You're not insulated from systemic risk around the world, and certainly as a commodities guy, a high dollar is a real issue for me.
Think about Coca-Cola that sells in Brazil, right? And they're earning in reals, but if the real's gone down 10%, now their earnings are down 10%, or the earnings that are coming from Brazil are down 10%.
Right.
So even though you say the fiat doesn't matter, well, that's a good case where fiat is affecting the cash flows of the instrument in which you are invested in.
Okay. Well, I don't want to ask you a crystal ball type question. I'm not going to ask you what the Fed's going to do next week. But I will ask you, if you will, the near-term trend, what's happening right now? I mean,
Yeah.
if we had had this conversation last week, the answer might be a little different, because last week it started becoming apparent that the ECB really was. I'm not saying that it was obvious they were going to go 50, but clearly they needed to respond to inflation and do something, and that is relevant to the relative pressures here for the milkshake, and who's got the biggest straw. So how do you see those trends right now? Do you see the Fed continuing to have the biggest straw in the milkshake for the near term, like the rest of this year? Or is there a chance that weakening signs in the U.S. could cause the Fed to not pivot necessarily, but maybe not be as aggressive as some of the others, and therefore affect the milkshake balance? How are you looking at the balance of this year?
So so first of all, I'd say the dollar's had a huge move. I mean, it's due for a breather, and I think it was at 109 a couple weeks ago. Now it's at 107, so it's already pulled back a little bit. It could easily pull back to 105 or 102 or even 100. That wouldn't surprise me at all. But I think between now and the end of the year, the dollar goes higher. What happens in the very short term, I'm not sure. I expect them to raise the Fed to raise 75 basis points next week. And then we don't have anything for like a month and a half until September. It's possible during that time period that the dollar kind of just languishes. Maybe we just go sideways for a while. But I think between now and the end of the year, the dollar goes higher again and makes another run. And part of the reason is, again, when you start talking about fiat currencies relative to each other, is you can't just focus on what the Fed is going to do. Europe, they raised rates today, but they had to simultaneously introduce this new facility.
Yeah,
that they can go out and buy
I noticed that.
bonds,
No contradiction there at all.
So in Italy's government collapsed. The whole of Europe has an energy problem with no gas and going to have to buy from Russia in a few months, or they're still buying from Russia. So the short-term future for the European area does not look really strong. And on the other side of the world, you've got China, who's got real estate problems in their market, and you've got Japan, who's doing yield curve control and has promised to never raise interest rates and buy as many bonds as it takes. So
that just came
really
out today as well.
because-
The BOJ today just said no intention of ever changing. Like, whoa.
Right. So it's possible the dollar pulls back a little bit, but I don't see another dramatic dollar sell-off between now and the end of the year. So I'm maintaining my position that the dollar is going to get a lot stronger and it's going to cause a lot of problems, kind of global chaos before this is all said and done.
Well, Mr. Sunshine, okay. Thank you for that.
It's raining today. I'm just reflecting the weather.
It is. All right. All right. Well, that pretty much covers my questions. And any last words? I'd like to end on a more positive note, but tell it like it is, brother.
This is the way I would wrap it up. I think a lot of times when people first hear me talk about the dollar, they think that, and I will occasionally make some jokes about being a gold investor and it's taken forever and all this stuff. It doesn't mean that I don't think you should own gold. I definitely think you should own gold. The other thing is that a lot of people's bedrock reason for owning gold is they think the dollar is going to go down a lot. I actually believe that a stronger dollar is more bullish for gold than just about anything else. In the short term, it's a headwind, but it blows up the entire monetary system, and nothing is better for gold than blowing up the entire monetary system. So, keep an open mind, don't put all your eggs in one basket, and just try to keep a level head through the craziness.
Very good. All right. Well, thank you very much, Brent. I appreciate the update, and we'll have to touch notes again in 6 months or something and see how it plays out.
Happy to do it.
All right. Have a great day.
Thanks.
Thank you for watching this edition of In the Pit with Lobo Tigre. If you enjoyed or found value in what you just saw, and you're watching this on any sort of social media, please do hit the like button and the share link. Send this on to anybody you think might be interested. That helps us out a lot. If you're watching this on YouTube, please do hit the subscribe button as well. The number of subscribers helps us get more valuable content to you as well. On the subject of subscribing, I'll quickly say that if you're not a subscriber to our free weekly Speculators Digest, I encourage you to sign up. I promise if you do, we will not send you a flood of daily advertisements. You get one free weekly digest with original research not published anywhere else. Check it out at independentspeculator.com. Thank you and have a great day.